Hi, everyone. This is Jason Bjark of Wall Street for Main Street.
And this is Lee Justo from Risk.
Welcome back for another episode of Finance Unspun. This is episode number 2. Now, Lee, I want to talk about Walmart earnings that were released earlier this week. I think it's important because Walmart represents a very large part of the U.S. economy, along with some of the other big box retailers like Home Depot, Target. Those stores are some of the main ones that Americans shop at, along with Amazon online. And the earnings for Walmart were not good at all. I think it was the largest drop of the stock since the 1980s. I think it was a 12% drop at one point intraday. So why don't you talk about some of the problems that Walmart released in their earnings report, Lee?
Well, I think two of the big standouts was a 32% growth of inventory year over year. And then they were 100 million over budget and markdowns on their hardline business. So it's like apparel and just basic stuff that you would buy there.
Well, I was also going to say that their costs were up. They just basically listed an itemized cost list talking about how much their wages, their labor costs, how much they had to pay workers more. They were switching to automation. Their transportation costs were up. And I think they just announced, 6 months ago, that they were hiring their own fleet of truck drivers and they were offering like $100,000 a year. So all these costs are up across the board, and then they have inventory problems. It just sounds like a mess to me.
Oh, no doubt about it. The same theme with Target. It was contrasted though by Home Depot, which had like record first quarter sales. So I don't know if you're familiar with what happened with Home Depot, but they blew out the numbers. And what's interesting, they're suffering from the same things, but I don't think it has impacted them yet. They're having a growth in inventory. Their gross margin is down, and their average ticket is also down. So they're having fewer people buy things, and the average ticket price went up, but I think that was mostly due to inflation.
And Home Depot is a good representation of the housing market here in the United States. The U.S. housing market, there is a shortage of houses. However, for the buyers of homes that need financing, that either have already bought a home and are using a mortgage, their mortgage payments are up enormously. And for people who need a mortgage, those costs are much, much higher than they were 12 months ago.
From an everyday standpoint, everywhere you go, you're seeing prices increase. Obviously the gas pump, the diesel pump is an obvious one, but in the store, when you buy anything, prices are going up, and I don't see them coming down anytime soon. That's definitely having an impact on what people are buying.
And what we can learn from Walmart is that a lot of their consumer discretionary items, they're not selling those. So that inventory buildup, Lee and I were discussing this before we started recording. We think there's a number of reasons for this. Lee thinks that the retailers panicked and stockpiled inventory because they were worried about shortages and supply chain problems. And I think that is one of the reasons. But I also think the other reason is that the consumer, a lot of these discretionary items, the consumer no longer has the savings or the consumer discretionary income because of the higher mortgage payments in middle America and other parts. Here in the DC metro area, a lot of buyers are still paying all cash. There are still bidding wars, but in other parts of the United States, there are not as many all cash bidding wars, and people use mortgages to buy homes, and they're servicing those. So the mortgage costs are up enormously compared to 12 months ago. I think I just saw this statistic going around. I think 43% increase on average, according to Redfin, we have for mortgage payment increase just in the last 12 months. And then on top of that, Lee, as we discussed in the last show, I see no sign, unfortunately, Lee, of things getting better on the food and energy front. In fact, I interviewed oil hedge fund manager Josh Young last week, and he said there's going to be gasoline shortages. We just had a news story that came out in the last couple of days saying the state of Washington, the gas stations there are adjusting the gas station pumps so they have the ability to start charging $10 a gallon gasoline in the not too distant future. And then we're seeing news stories come out in the last week or two about India banning exports of wheat. The U.S. Department of Agriculture is projecting a 4-year low for the global wheat crop. So just more bad stories potentially for higher food prices, higher energy prices, and a lack of investment. Long list of problems, unfortunately, on the supply side, either due to a lack of investment or those supply chain problems that unfortunately are not getting better anytime soon.
Well, an interesting thing that's going on in the supply chain. If you remember a year or so ago, there was a huge backup of ships going into California ports and also Charleston and a couple other major ports. New York, New Jersey wasn't really impacted even as close as 6 months ago. But now they are. They're getting a backup. There's over 120,000 containers, I believe, in the port of New York and New Jersey that are empty and sitting there and have not been moved off. So what happened was everyone shifted from California to other ports as kind of like a risk management, if you will. And now those ports are getting overwhelmed too. So it's just going to get worse.
And we had Shanghai's port, which is one of the top ports in the entire world, that was offline for a while. I think that just restarted in the last couple of days. So that's going to increase oil demand, gasoline demand again, diesel demand again. So whatever supply side problems and shortages we're having, and oil refining stocks are already ripping. I think Valero, those shares are up enormously just in the last month or two. Valero is one of the top oil refining stocks. I mean, it's already up so much. I wouldn't go out and buy the stock right now.
Well, we were talking about Warren Buffett and Stanley Druckenmiller and what they were investing in, and this ties into what you're saying. Buffett took positions in Suncor, Canadian Natural Resources, and Chevron. Stanley Druckenmiller, he actually had bought a lot of puts on the S&P 500 for the first quarter. I'm sure he's probably covered most of them by now. He's just an excellent trader. But he also took positions in Coterra Energy, Chevron, Pioneer Natural Resources, Tech Resources, and I believe it's Synovus Energy. So the basic theme is natural resources, oil, gas, as well as Canadian oil.
And despite their politics, because Warren Buffett's a hardcore Democrat, Stanley Druckenmiller is a hardcore Democrat, these guys are acknowledging, in my opinion, that there are long-term problems on the supply side for oil and natural gas, and they want to make money. So even politics aside, they still want to make money in their trades and their investments. And Lee, you were talking to me about the diesel prices that you were paying, and you drive a lot. Well, one of the ways to offset this then, maybe a hedge, is to have exposure in your investment portfolio to energy. So if your energy stocks are doing okay, they're somewhat offsetting at least those high diesel prices, high gasoline prices that you're paying at the pump.
It's definitely something to think about. The question is, how long will the bull run with diesel and with natural resources and oil and gas? And I think it's going to be a while. What do you think, Jason?
So if we do have a general stock market crash, and yes, we've had a liquidation phase for the last couple of weeks, but if things were to get worse, like worse margin calls, the cycle feeds on itself, the bear market gets even worse. A lot's depending upon what the Fed says and does. I mean, the Fed's scared to reduce their balance sheet at this point. If the Fed announced that they were reducing their balance sheet, Lee, and they haven't officially reduced their balance sheet yet, but if they did, I think we'd see 15, 20% down, maybe more within a couple months if they did announce a substantial balance sheet decrease, which is why they haven't announced one yet. So in that scenario, and we've talked about this in the last show, I've talked about this publicly, you want to have some cash because there will be opportunities in that scenario to go buy good potash stocks, to go buy good oil and natural gas stocks. So you're not going to miss just because the oil refining stocks like Valero or Chevron's up enormously, or now you've had corrections with the top uranium miner, Cameco, or the safest one, I would say Cameco, and then all of these profitable potash stocks. Just because these are down, they're still up substantially over the last couple of years. And I do not think the bull market in food and energy and these plays is over. In the short term, almost anything can happen. Unfortunately, a lot depends on what the Fed says and does. And the markets, the high frequency traders, the leverage traders, people using leverage trades will react violently to what the Fed says and does. But on the fundamentals, the supply side, the food and energy problems, that bull market is not going away. If there are buying opportunities, I do not think there will be a long-term bear market in those. I think the bear markets in those are over.
I agree with you. I think we're in a long-term secular bull market in commodities, and it's here to stay for a while.
Well, if you look at all the potential shortages, you see the food riots, you see the stuff going on in Sri Lanka, the last 6 or 7 months in Kazakhstan, There are tons of people in the world that need staple crops for food. The USDA, as I said, is predicting a 4-year low in the wheat crop, and India just banned wheat exports. So these are not going to help the supply side for food. And then higher energy prices means higher food. And we do not see, as of yet, even if there is an oil crash, even if there is a crash in commodities, Lee, I think, and credit contracts, I think actually that will create more long-term supply problems, because then these oil and gas companies and these mining companies will not make the investments into adding more long-term supply if there is a crash. Plus, if there is a crash and there is a credit contraction, at least temporarily, a lot of these oil and natural gas producers and mining companies need debt to grow their production. And in that scenario, they would not be able to get the debt needed to bring a new mine online. At least a portion of the new mine is going to be financed with debt, and same thing for oil and natural gas producers. So if there is a crash in commodities, this could actually make the supply problems. Yes, the price of the commodities would go down. Yes, your oil and natural gas producers and other types of commodity plays would go down in the short term. But in the long term, this would create potentially even more supply problems unless demand collapsed. And I think with these investors, what you're seeing is a commitment with the big name investors like Warren Buffett and Stanley Druckenmiller. These guys are not known for buying natural resource companies. They're not normally known, especially Buffett, because Buffett is more of a consumer discretionary income or a regular basic business. He likes free cash flow, consumer monopoly companies. I just jumbled over that. He likes consumer monopoly companies, not natural resource companies, mining companies, oil and natural gas normally. And Buffett has continued to increase the size of his positions for Chevron and Occidental Petroleum lately too as well.
Yeah, Druckenmiller also purchased some Chevron. And neither one of these guys are known for really short-term trading. They really kind of hold. I mean, Druckenmiller is probably in and out quicker than Buffett is, but I think they're committing this capital for more than a month or two.
And the other interesting thing that we saw from Buffett's announcements is he liquidated an enormous position from Wells Fargo Bank. And Wells Fargo Bank has a lot of exposure to real estate, a lot of exposure to residential real estate, commercial real estate. There was an article in the last 18 months from a whistleblower who designed these mortgage-backed securities, commercial real estate mortgage-backed securities. And he alleges that Wells Fargo has $1 trillion of bad leverage loans, collateralized loan obligations, similar to junk bonds that are chopped up into these derivatives, and then also commercial real estate mortgage-backed securities hidden off balance sheet in a special purpose vehicle. So maybe Buffett is cashing out because he realizes what's going to happen with higher mortgage rates and problems with Wells Fargo, and he's moved into more oil and natural gas, acknowledging the supply side problems and much higher gasoline prices in the future.
You know, he did dabble more into reinsurance, which is an area that he's invested in for many, many years, which is interesting.
So reinsurance actually gives him more cash to invest. So that's why he's invested in a lot of these insurance companies, is so he had access with Berkshire Hathaway to investing in the floats of these insurance companies. I've read a lot of Warren Buffett and value investing books over the years. Buffettology is probably the best one I've read, which explains his value investing philosophy very well. So as we wrap up the show here, we have one more topic I want to discuss, because we're going to try to keep these episodes around 20, 25 minutes each or less. I wanted to talk about the history of bear markets and stocks. So probably the longest bear market in stocks was post-October 1929 crash. In a bear market, in a classic bear market, you have like the liquidation phase, you have enormous amounts of selling. Now, a trader who is looking at this would think right away, without maybe studying financial history, that, okay, fine, I'll just short it. But the shorts tend to not do extremely well during long bear markets because of these bear market rallies. So the Fed could issue a press release, the Fed could try a stimulus program, the Fed could say they're not going to reduce the balance sheet. Any type of statement from the Fed that could be interpreted by market participants as even somewhat bullish, that could potentially cause a rally in stocks or other types of commodities. And then that could cause a short squeeze and rip the shorts. So the bear market rallies are actually what kill the shorts during the history of bear markets. But if the Fed continues to increase interest rates, Lee, don't you think that it will break even more things?
You know, the way markets work with short selling, you really have to be very quick as a short seller because the bear market moves down are very quick. The bull market moves tend to be much slower and more progressive, if you will. You should not be taking short positions unless you really are a good trader and know what you're doing.
Also, if the Fed announces additional interest rate increases, the existing bonds that are outstanding, so the existing junk bonds, the existing US Treasuries, those would get hit.
Yep,
those would get hit. So I think the average person does not understand this, that bonds are inversely proportional. So the existing bonds, their principal value becomes worth less. So you would still get paid your coupon unless it's a junk bond and the company defaults, but the US federal government will pay out coupon. So you will still get paid your coupon, your interest payment, but the principal value of the bond, the existing bond, it becomes worth a lot less if the Fed increases interest rates, because then the newly issued bonds are going to be offered at a higher interest rate.
And the interest rate is dependent on the issuer, how much they need to drive demand. I mean, the higher the interest rate is on a bonds, the more demand for it typically there is, because it's more valuable. It's paying you more.
And I was going to say the reason that we bring this up is because a lot of people recommend in a bear market or a deflationary period to go to cash, to go to US dollars, and to go to bonds and treasuries. However, if the Fed is hiking rates, the normal safe haven of US Treasuries, the existing ones, not the newly issued ones, those ones would get killed in a Fed rate hiking scenario.
Yes, absolutely. I mean, in a bear market, there really is no safe place other than you sit in cash and hopefully you can buy down the road something valuable that you can hold on to. But
so that is a very important point, Lee. Rick Rule has actually said this in the past, that in a bear market, return on capital is not as important as return of capital.
Absolutely.
So I would say the winner, if we do have a prolonged bear market, and again, a lot depends on what the Fed says and does. Okay. A lot depends on what the Fed says and does. So if the Fed says that they're done hiking interest rates, stocks may rally, US Treasuries may rally, because then there's not the threat of higher interest rates collapsing the value of existing bonds. So a lot really depends on what the Fed says and does. But again, in a classic bear market, though, I think the winners are people who play it safe, who are smarter, who don't take as much risk, who don't go out trying to short all these different things, all these different plays. Because there's always the risk then that the Fed panics, issues a new press release, and then that will create a short squeeze, a bear market rally in something. And then as a short, you're going to get killed.
There's no doubt about it. I mean, if you are a short player, you always need to take profits very quickly. And then you wait for that rally to peter out and you go short again. But I would highly recommend that anyone out there who's never shorted before, do not get into it. It is a very dangerous game. And, I've spoken to many professional short sellers who have gotten squeezed pretty intensely.
Well, look at AMC and the GameStop people. I mean, the fundamentals of those businesses, AMC movie theaters are not doing well at all. But
Same
they raised
GameStop. Yep. I had a conversation with David Tice. He ran the Prudent Bear Fund, and that was I think the first professionally managed short mutual fund. And boy, he had a really, really hard time during the tech bubble. Precious metals somewhat saved him in the fund, but I was an investor in it back then because I thought the concept was pretty intriguing. But boy, so many people lost so much money for so long, and then all of a sudden it made rain and it started paying out. But it was a short-lived thing, so you have to be quick in and out.
The other thing about shorting, and I don't do shorting, is the timing of it all. So I was writing an article, I want to say around 2 years ago, about Netflix, talking about all the problems that Netflix was going to have, but who knew that I was totally wrong on the timing though. So up until a couple months ago, all these problems that Netflix had, no one cared. No one cared that they were raising their prices and their subscriber growth had slowed and their woke culture, as long as they were growing subscribers. But look at all the competition, all these other streaming services content creators, content providers now that Netflix has.
Well, you had mentioned Disney, and the price differential between the two is really substantial.
Yeah, it's enormous. Disney has over 100 million for Disney Plus. They have over 100 million paying customers already. Now, they did have to discount to get people to try Disney Plus, but once people try the service, they don't have an enormous amount of cancellation. So they're growing pretty rapidly, and they're not discounting as much. And in 5 years or less, they may have more paying customers than Netflix.
I think we should wrap it up here. It's been a very good discussion. We've covered a lot of things, and I'm sure there'll be more interesting things to talk about next time.
Yeah, I just want to end this one more thing here about like the higher diesel prices, gasoline prices. So for the Q2 earnings that we're going to see coming out in the next 6 weeks. Mm-hmm. Yeah. So the Q2 earnings that we're going to see coming out in the next 6 weeks, they are going to be ugly for the businesses for mining and manufacturing. So if you're a German manufacturing company, your costs are up over the last 2 years, over 40%. Your energy costs compared to other countries are up enormously. You have shortages of key inputs that you need. For a lot of these businesses like mining, a lot of the miners, unfortunately, do not hedge. The ones that do hedge, like their energy input costs with either electricity or diesel, they don't hedge nearly enough. And you're going to see unexpectedly bad margin problems, unexpectedly bad input cost increases and cost control problems. I put out an article for patrons about this on Sunday night about silver miners that announced earnings last week. And we had an enormous spike from silver miners in their costs. But one of the silver miners, First Majestic Silver, they don't have a profit margin right now. So it's going to be ugly for some of these higher cost miners and the miners that did not hedge, because mining, especially open pit mining, uses an enormous amount of diesel, but other businesses that use an enormous amount of energy that did not lock in a long-term diesel price, say 3, 4, 5, 6 months ago, lock it in for a year, 2 years or longer. And you have to pay a lot of capital up front for that. So that's what you're going to see in the next 6 weeks with the Q2 earnings. You're going to see margin compression. And then you're probably going to see, because Walmart is such a good representation of the US economy, you're going to see a lot of similar things in the earnings for Q2 for a lot of these other businesses, that consumer discretionary budgets are down because much higher interest payments on mortgages, much higher food costs, gasoline. The consumer is strapped, does not have a...
getting squeezed. Yeah, absolutely.
Yes. And then the makers, the manufacturers of these items, either they have shortages of the goods that they need to make the item, or their costs are up enormously with energy costs and materials costs. So overall, it's going to be a tough period going forward until we get potentially more clarity from the Fed. But if the Fed, in my opinion, does announce further interest rate increases, this will break even more things.
Hopefully you're not in Bitcoin either. There's no safe haven, I'm telling you. Anyway, thank you so much, Jason.
Well, Bitcoin is as we wrap up here, Bitcoin is a quote unquote risk on. Bitcoin is risk on. Yep. And there's a lot of hidden leverage in Bitcoin with these stable coins and the exchanges like Coinbase and these other exchanges were giving a lot of traders tons of margin to trade on. So when you have margin. Yeah, so when you have all this extra margin for stock trades, for crypto, and you have falling asset prices, that's going to create margin calls. It's going to be a vicious cycle. It's going to feed on itself.
I think over the past few months, we've seen a tectonic shift in the markets across the board.
I think there's been also a lot of forced selling, forced liquidation. So some people, some over-leveraged traders that had profitable oil trades, profitable natural gas trades, profitable uranium trades, profitable fertilizer company trades, and potash company trades, they had to sell some of those positions because they had losing trades and margin calls elsewhere. So they were either forced to sell, or they took the winner's profits off the table to cover losses on other over-leveraged trades that were losing.
Exactly.
Okay, well, I think that was a great show for episode number 2. And Lee and I are going to work on getting a logo for Finance Unspun, hopefully in the next couple of weeks.
Thanks, Jason. Everyone have a great weekend.